Okay, Syntel. Syntel was established, I think, 1989 or 1991 in Michigan, United States. And despite it has a headquarter in United States, majority of its employees in India. Okay, and this is a big company. And what they do, they work with outsourcing of different services and in IT industry, okay, in IT sector, but they work with different companies in different industries. So majority of their business in banking and financial services. Second business is healthcare, then life science, insurance, manufacturing, retail, logistic, and travel. So they work with some of the biggest companies in the United States in those areas. And if you look, probably four biggest clients, their clients represent nearly 40%, 48% of their sales level. Now, from one point, it is quite dangerous because imagine if one client leaves this company and switches to another company, what is going to happen? They're going to lose quite huge level of revenue. Last night at our club meeting, we looked at the company, what's the name of it, Dory, which produces mattresses and pillows, and they lost, yeah, absolutely, Tipper. And what they've done, they lost one chain, like which they're dealing with, and what happened with their revenue, like in sales level. Their profitability went down nearly like 3 times, from $3 with something to $1. Right. Of course, there are other reasons for that, but main reason, they lost a huge customer, which represented 18% of their sales level. Okay, so similar situation can happen with Syntel, but the difference is here that Syntel is not a simple outsourcer. Now, if you look at their competitors, what you will see that majority of Indian companies, the way they outsource is that it's a customer service. So when the client calls to customer support, the phone is directed to the Indian call center, and people there answer like simple question, usually based on a script. So, hi, how are you doing? What happens? Like, what's the problem you have? And then start asking questions starting from there. Do you have electricity? Did you plug your computer into the socket? So do you see a mouse on your screen? And something like that, so very, very simple and question. Whereas Syntel has a much deeper integration with their clients. And what they do, they outsource business processing. So when the company, for example, setting up acquisition of clients, like marketing campaign, and then sales channel, and after that they look at, for example, dividing customers in different groups, and maybe working with their like sales processing, and like all aspects of the marketing and sale process. For some companies, for example, financial services, they cover. And you probably understand that when company integrated so deeply into your activities, it's much more difficult to switch to another supplier. And some of their clients, biggest clients, they work with Syntel since 2001. So it's more than 15 years. And you understand that if the company, these two companies, they have this kind of working environment for so long, it's quite difficult to switch to somebody else. And then also, if you think about it, okay, if they decide to switch, who are they going to switch to? Now, they might switch to another company, which similar to Syntel, but Syntel is a leader in this industry, like from price competition, but also from margin. So they have some level which they can go and discount price. So if somebody decides, some company decide to switch because of price, Syntel is the best company to handle it. I mean, other companies, they have much lower margin, so they cannot go low in prices. It's first thing. Secondly, if they decide to switch to US providers, straight away they won't be able to find price competitive company, because if you're trying to employ same type of personnel in United States, you would have to pay 10 times more for this employer rather than you hire it from India. So in India, the rate between same qualification sometimes varies 10 times. Okay, so if you paid like $10,000 a year for employee in India, you would pay for the same employee $100,000 in United States. Okay, that's huge difference, and that's how Syntel makes money, because they can employ people from India and then provide services in the United States. Okay, now that's what happens with Syntel, how they operate, and what we see for the last year, their clients. One of the reasons why their sales level decreased and earnings decreased, because those companies who they're dealing, they stop spending a lot of money. At the moment right now in United States, they're talking a lot about changing different changes in visa for foreign workers, and it might affect Syntel business, because they not only employing people from overseas. What they do, they provide work visas for some of the employees, and they bring them to United States, and then they subcontract them to the all these companies, because majority of these banking and financial sectors, they don't want to see employee only online. They want to see them on site. They want to see when person comes to the bank or comes to their office and fix or do something just right there without kind of dealing with them online. But again, so if this visa would be affected, they might not be able to provide new employees for that price, and they would have to employ US employees, which straight away will kind of increase the cost for Syntel. Okay, that's one of the concerns, what is happening right now. All right, let's have a look first of all at value line. Now, value line is a bit different. So if you got used to different type of value line, so you can see value line doesn't give projection for 3 to 5 years, so we can see only for a couple of years, and probably they're not that precise. Okay, so let's have a look. So sales level per share. We also can have a look at sales per company. From 2008, I don't have the data here, but by reading different resources, I can tell that they had a growth before that too. So we can see $4.9, $5, $6, $7, $8, $9, $10, $11. So what can we see? Constant growth, right? So which is pretty good. Now, growth is growth. For us, important earnings. So what can we see? $1, $1.43, nearly 40% growth here, but then like few cents down. So that's probably the 1 year which had a decrease in earnings, and then we can see again 1.4, 2.2, 2.6, 2.9, and $3. So constant growth. We can see that it slowed down in 2014 to 2015. Okay, and then value line was telling that it's going to be about $2.50 profit. So it's about 80-90% decrease, but it had a loss in 2016, and that's probably the biggest reason why the share price went. The maximum we can see it was $59, $52, or sorry, nearly $53, and at the moment the price is $16.50. So it's much lower. So it lost fell 3 times of the highest high. Okay, in 2015. So, and we need to understand why did it happen. Okay, what happened? The problem which exists there, is it temporary problem, or it's a constant problem? So is it going to stay there forever and keeps the price down, or the company is going to recover? So that's the important question which you have to ask. Now, another thing which I ask you to remember is first, let's have a look, P ratio. Okay, and try to remember numbers. So 13, 11, 11.3 is the lowest one. So if we look further, it's the lowest one. The highest was 17.4, and then 12, 13, 14, 15, right? So probably if we look at the last couple of years, we can see it steadily was growing. So people were feeling more and more confident with this company, and they were happy to pay 15 times of their earnings in 2015, right? Whereas in 2008, they were happy to pay only 11 times of their earnings. And who knows what's the PE right now? Have you looked at this? So at the moment, there is no PE. Okay, and the reason for that, because they had a loss. If you look at trailing PE, it doesn't exist because they had a loss. Okay, it's very difficult to calculate the price union ratio if there is no earnings, right? So that's why value line tells it's non-meaningful figures. All right, so that's the thing. But if you look at forward PE, so forward PE, that would be around 9 right now. Okay, that's the thing. Now, the interesting thing about it, when I found this particular company and analyzed it, and then I went to different sources and I decided to see how other analysts like seeing this company. And what I realized that probably majority of high-level investors, they're going to miss this company. They're not going to find this company on their radar. When they're screening, they're using different screening processes. They're going to misuse this company. And the reason, because they have several problems, several issues, which kind of can hide this company from their radar. And we're going to look at it. First of all, imagine if this company going to, for example, somebody is going to try to find this company based on their PE ratio. Instantly, they're not going to find this company because this company doesn't have any PE ratio. After that, I'm going to tell you a few more parameters which are used during screening process. And again, this company is not going to be there. Okay, so okay, let's have a look. So we can see that previously it has a very high return on capital. Like Warren Buffett is trying to find more than 20%, so it's 21 here. Also, if you look at long-term debt, it's practically never had debt except in 2013-14. About $140 million, and then it gave it back. Okay, so they didn't have debt practically ever. So their tax rate from 13% to 20%. Okay, depreciation constantly, like steadily going. Okay, so we can see that everything here looks good, right? So do you see anything bad here? Tell me if you see anything bad, or you like at the moment what you see. If you don't know what is happening, so do you like it or you don't like how this company? Yes, absolutely. You're right. So it looks really attractive. It looks quite good, and I'm sure that in 2015, when people were screening this company, it would get on their radar. Okay, and now we're trying to figure out, okay, you already know what is going to lose, that they're going to have a loss, but let's have a look what is happening further. That's what we can see quarterly. Let's have a look quarterly earnings. Now, we can see that in third quarter 2016, they had $2.5 loss. Now, interesting enough that, look, the sales level during that quarter was 241 million. Exactly the same as first quarter. So same level of sales, but in first quarter it was representing 63 cents of profit, whereas in the third quarter it's $2.50. What happens? I mean, sales, same level of sales, but why the profit gone? Why is the loss here? Guys, do you have any idea? Why do you think it happened? What kind of things can create that? Yeah, definitely, Dean. Yeah, it's high expenses. But expenses of what? Like, give me some examples, because that's the very important point. If you know what can expect, what can happen, you can go in a financial statements and look specifically in certain things, and it will take you only 2 minutes to find it. Okay, and then you will make a great profit. Okay, Dory, capex, tax, dividends. Okay, now about dividends. Dividends, they don't reduce income because like if we're looking at profit and loss statement, dividends, they are paid after, right? So first you have income, after that you pay dividends. So dividends, they affect what? They affect the balance sheet, they affect your assets, but they don't affect your proper. Ian and Nona correctly, so legal. So if there are different fines, right? So if company has some kind of legal issues right now and they have to pay fine, that would be an expense, right? So, and they have to pay it, and it might affect the profitability. It wouldn't be operational profitability, right? But it would be extra expense which company has. And for us, it's important to understand, is it one time off legal fee, legal payment, or is it going to continue after that forever, whatever? So maybe it's lost in some patent rights and now they paid some fees for that and now they have to pay some patent fees. So that's one thing. But again, and also Dory said taxes. Okay, so if some extra tax or something like that. And let's have a look at this one. Another thing what might happen here is depreciation. So when company decided to depreciate some extra stuff, okay, and maybe to increase the level of depreciation, it might affect it. Another thing, it's write-off of goodwill. So some companies decide to do it, and for whatever reason, 30% of their goodwill. So it will create extra loss because they do it through the loss. Another thing, it's inventory. They have inventory which, for example, going bad, for example, pharmaceutical company or maybe toiletry and cosmetic company, they have some stuff and they understand that it's going to be like expired soon, so they write it off. Or maybe it's fashion industry when they have all these fashion products which already out of date. So for example, last year design, nobody's going to buy it, so they have to write it off as well because they can't sell it. Okay, so that's the thing can affect it. So let's have a look what was in this particular company. Okay, what was the reason of fall right here? That's actually another point. So if you're screening this company using FinViz, and I know, Dory, you like to do that, so that's what you're going to see. Now, you can see income minus 57 million. Book value. Another one, look at this, minus $2. So it has negative equity. Now, after that, we can see PE ratio doesn't exist. So it means that company is losing money. Earnings per share this year, like the reduction is 122%. Okay, earnings per share past 5 years, 19%. So it tells you that in the average, it's 19% decrease. Even though we looked at value line and we could see that they had constant growth until last year, and only last year they had this drop, huge drop in earnings, right? They had a loss. And that's why, but when you see it here, because it's averages, and now we can see like it has an average drop 19% during 5 years. Okay, and sales quarter to quarter. So now by looking at this number, guys, tell me, are you going to invest in this company by looking here or not? And then you can see that it's dropped from 55 to $16. Does it give you confidence in buying this company? No, no way. So, and remember that there are more than 30,000 companies on the stock market. And if I have $1 billion or $100 million to invest, when I see something like that, I'm not going to spend my time for researching it further. I'm just going to switch to another company which has much better financials. Okay, so that's the thing. But for you, small investor, especially when you find something like that and you already dipped into it, you can find some bargains. Okay, because some other people will miss it. Okay, so let's have a look at more details. Now that's financial statement, income statement. Now for the last 1, 2, 3, 6 years. So that's what we can see. Total revenue 6, 7, 8, 9, 960, 966. So we can see that in 2016, the revenue only 2 million less, right, than previous. So it's quite low. Then we can see that gross profit 14 million less than previous one. Then we look at operating profit, operating income. So we can see it's somewhere 20 million less. So we can see something increase here because here it's only 14 million, right? Difference down. Here it's already 20. We can see that operating expenses, they grew up, and we can see that that's extra $8 million they spent it. Okay, before they had 109, 96, 13, so it fluctuates, but we can see that it's practically steady from 2011. It was 108, and now it's 108 annually. So nothing bad is happening here, and we can see operating income 262. The question is, how come like then it goes to diluted net income minus 57 million? What happened? What can you see? Where's extra expense which they didn't have before? Can you find it? It's all here. Correct. Provision for income taxes. Look at, they had 7 million, 69, 70, like all in the range of that. It was growing based on their growth. And then bam, $330 million. The question, why did they pay so huge tax? What happened? That's one of the things, right? So they might sell property and paid capital gain tax, change in tax laws. But imagine it's like huge increase, like tax fines. Okay, good guesses. Now the interesting thing, I'll give you a hint. The question is, why Microsoft keeps more than $50 billion in Europe and doesn't want to bring it back, this money doesn't want to bring it to United States? Until money comes to your country, you don't pay taxes. When you bring money to the country, you pay taxes. Very often what they do, because it's like in operations, they don't show it's like a final profit within the company. It's still profit for the company, but it doesn't go into the tax office of that particular country until you bring it there. So that's what's happening. That's why Microsoft is aggressively buying a lot of companies in Europe. That's why Microsoft bought Nokia. Okay, one of the reasons, because they wanna invest right there without paying tax. And imagine that Microsoft brings back $50 billion, 30% tax, $15 billion they will be paying taxes. So similar situation happened here. Okay, and company brought back nearly $3 billion back to India, and they had to pay taxes on that. So that's the reason why the tax is so huge. So now the question for you. No, from US to India, because they had, like at the moment, is located in India. So it's Indian company. So the question is right now for you, is it one time of payment, or is it going to pay this amount every month or every year? One off, correct, Ian? So it is one off payment. So what can we expect after that? Can we expect that the level of profitability is going to be in the same line as it has? Yes, absolutely. So that's one problem. That's one problem which, like, I mean, issue which affected the price, okay? And because, believe me, a lot of people, they're not going to research the company after they see this loss. They just want to continue and start researching some other company. So when they see the loss, they don't pay attention to this company. And of course, there are less buyers than sellers. And some people otherwise, as soon as they see this loss, they start shorting this company without paying attention why it's actually happened. Okay, so that's the one thing. Another thing which is important for us to understand what happened there is, let's have a look. Now, that's the income statement. You can see here, that's quarterly right now. You can see here it was minus $2.5 loss. And it was 286 million in profit on that particular quarter. Oh no, provision. It was 69 million in profit, and then they had 286 million in taxes, and then that's their loss. Yeah, absolutely. You see it in the charts. When you look at charts, you can see it straight away, that loss. When people saw it, they sold it off. Because majority of people see their loss and that's it. Okay, they expected profit like that, they had a loss, they start selling off. So that's the thing. Okay. Now, another thing which is very, very important for us to understand also, let's have a look at balance sheet. Another issue what happened here. And again, I will try, don't look first on this line, but try to, I will ask you, they had $14, nearly $15 per share, okay? Total equity here, total equity was $1.57 billion, and it was growing 1.21, 1.25, right? And look at this, and then it becomes negative. Straight away from 1.2 billion to 220 million negative equity. So they have higher level of debt than assets. The question is, why did it happen? Now, I especially hidden that you don't see, but try to think what might happen that affected it. Yes, and retained earnings gone. So what happened? How come company can lose so much in equity? So you understand that two structures. One is equity, assets, and then another one is liabilities. And the difference between assets and liabilities is your equity. Because if you sell all your assets at the price which is specified in books, and then you give all your liabilities, whatever left is your equity, is equity of your shareholders. But at the moment, within 1 quarter, it has changed. It's changed from positive 1.2 billion to negative $200 million. So $1.4 billion just disappeared. What happened with the company? Where can the money go? To India tax office? One thing, yes, okay. Share buy, if you buy shares, that wouldn't affect so much equity per share, because you still you're reducing the amount of shares, but that might affect it, but not on such a huge sale. And still, in this case, you will have positive equity in any way. So the question is, why so much changes there? Any other ideas? If you have a loss, okay, they bought a companies for cash. When you buy company for cash, very good try. If you buy company, you buy an asset, right? So if you have cash and then you just buy another company, then you put that company on your balance sheet, it becomes an asset. So your total asset level wouldn't change. It will be still the same. The only difference is that before you had cash assets, now you have goodwill or maybe other assets which you purchased. So it won't affect that. So how can you break this balance? Now, okay, the question is, if you have a loss, is it going to reduce amount of your assets or increase amount of your assets? Reduce, correct. Because, for example, if your company has $2 million in assets, and then you have $1 million in liabilities, so your equity is 2 million minus 1 million, so $1 million in equity. That's you. If you sell your assets, give away your liabilities, you will have $1 million for whatever amount of shareholders there. Now, if the company within next year had $500,000 loss, so what happens? This loss is gone, right? So this money is gone. So next year you have $1.5 million in assets and 1 million in liabilities, assuming that it didn't change. So if you sell those assets now and then give away liabilities, you will have only $500,000 in equities. So your equities will reduce. So that's why when you make your profit, your equity like grows. When you have losses, your equity like reduces. Okay, you understand that? Okay. The next question: if you decide to pay dividends, how does it affect your balance? If you pay dividends, so part of money which in cash right now in the company you decided to give away, another. So would it be reducing your equity level or doesn't change it? What happens? Correct. Correct. So it's reduces it. It's correct. So because if we pay something, for example, if we had $2 million in assets and then we had $1 million in liabilities, the total equity would be 1 million. And if we have, for example, $500,000 in cash, out of that 2 million assets, we have $500,000 in cash, and we decided to pay it as dividends, and we gave away to shareholders. So within company, shareholders' equity was reduced by $500,000. So now our equity within the company $500,000 only, because 1.5 million minus 1 of liabilities, but we got it cash in our personal possession. And now let's have a look what happened with this company. Okay, let's have a look. And now it's balance sheet. So okay, in balance sheet we actually can't see that what happened. We only see that equity gone, right? But when we go to cash flow, that's what we can see. Now, total cash dividend paid. What we see? 1.261 billion, 1.261 billion of dividends was paid. And now remember here, what was our equity? 1.257. So that was whole equity which we had, and whole equity was paid out, everything. So whatever we had in equities, we decided, okay, we're going to withdraw it from company. And then on the top of that, we had to pay about 300 million in taxes. So, and that's why company, if you look at balance sheet now, it has a negative. It's not only zero, it also has negative. So it's that's why the total equity becomes 2.6 minus. So they had actually $15 in dividends. So everything what they had $14.96 in equity, and they paid $15 in dividends. So they paid everything what company had, and then they had to pay, they borrow money in order to pay taxes. Okay, that's what happened with this company. Now, if you investor and you're screening it and you're trying to find companies with a good balance of equity there or assets and liabilities, are you going to look at this particular company or not? Are you going to find that? You're not going to find it, because at the moment it's negative equity. You're not going to invest in a company like that. It wouldn't get into your radar. So, and the question, another question, is it good or bad when company pays dividends like that? Why dividends so high? Okay, good question. Now, in reality, first of all, you will ask, why the heck they brought 1.2 billion in order to pay so much taxes? Why wouldn't they bring it gradually, right? Maybe 200 million, then 200 million, and then gradually pay taxes. Why did they bring everything in one shot, first of all? And secondly, why did they pay? They actually, what happened, everything what they brought, they paid in dividends. So when you think about it, they wanted to bring this money back to the country in order to pay these dividends. That's the reason why they brought this money. They wanted to pay this dividend. Now the question, why? Why they didn't do it for so many years and then decided to pay? And the reason for that one active investor fund, they bought into this company and I start pushing it. They told, look guys, that money, which I brought, you don't buy anyone. You're not growing by acquisitions. Their money just laying there doing nothing. It's much better if we bring it back and give it to shareholders. Okay, and then shareholders decide how to invest it. That was the reason why the money was brought to the country and then distributed as dividends. Okay. Now, yeah, you're right. Shareholders need money for something else. Now, the question is, like for you, is it good when company pays dividends or is it bad? And maybe in some circumstances, paying dividends is good, in some circumstances is bad. Okay, only good if sustainable. Okay, any other ideas? Weak management. Only good if they have nothing better. That's correct, Dory. Very good answer. Now, so imagine that you have $2 million in cash in your company. If you have an ability to invest this $2 million and get return higher than average, right? So for example, you can invest this equity with 20% return. So each year, by putting this money, you might generate $400 million. Now, that would be much better, right? To invest this money rather than give it to shareholders, because shareholders in this case have to think now where to allocate this $2 million. And maybe they won't be able to find a company which can invest with a 20% rate of return, right? That's what we saw rate of return on equity in this company when we looked at value line. Now, but some companies, like for example, Sony, they had losses constantly. They were making losses and they kept paying dividends. Now, is it a good thing to pay dividends when you have losses or bad thing? Why the company is doing it? If they have losses and they still paying dividends, they're afraid to lose their investors. Yeah, because what happens, but it's really, really bad practice. If you see that company in the long term, they are losing money, they're not making money, but still paying dividends, it's actually very bad practice. It's like, imagine guys, you lost your job, you don't make any money, you're spending money on rent, on food and everything, and then you decided maybe just go for holidays even more on a credit card. So what happens? You borrowed more money because you have to borrow money from somewhere in order to do this, or maybe you had some savings from previous job and now you're just wasting it. And if you're not going to get a job, eventually all this money will be gone, right? So you will be same with companies. So if company doesn't make money, it's two things: rather stupid management, which trying to keep their position there and trying to keep their shareholders happy, or they have idea or belief that they're going to make money in the future. Okay, it's same as with job. If you believe that you can find job instantly anytime, right? So you might, but if you're afraid that you might not find the job, you're probably not going to do that. Okay, similar situation with companies. Now, company paid dividends. So we know all gone. Now for Syntel, is it a good thing or bad thing? We don't know. In this case, you need to understand the activity of this company kind of quite deeper. And if you look at this particular company and you understand how they work, majority of payments, majority of their business is a like contract, long-term contract. and they don't take upfront payment, for example, for some product, and then they don't get any cash. No, they have a subscription-based payment. So if they sign up a contract for 3 to 5 years, then the company, their client, pays them on a monthly basis, okay, all the time for whatever service they provide. So Syntel can predict how much cash they're going to generate in the future. It's first, and secondly, their business is not cash like incentive. They don't require a lot of investments. They don't have to buy stock, right? They don't have to invest capital money, build the factory. They don't need. They pay money to their employees after they already get money from their clients. Okay, because that's how it works. So somebody bill their client like 40 hours of work of the employee, they charge client, and then they pay the employee. Maybe the difference would be they pay upfront employee, and then 2 weeks later they get from their client. So that's how it works. So they can predict that they can get cash. Now let's have a look what we see here. Imagine that was negative equity. Total equity was 220 minus in the third quarter 2016 after they paid. Look at this, fourth quarter, it's already 180. So it means that they put back $40 million. Now look at his 136 million. How much they put back? Another $46 million. So if they keep doing in a similar way, what is going to happen? How long will it take them to get into positive area again? If they keep putting 40 million or $46 million each quarter. So 3 quarters. Okay, so in 3 quarters, they will be back in positive. But the good thing about it, they don't have any debts, right? So the debt level which they have, okay, let's have a look, long-term debt. So it was 464 here, and now it's 428. So they gave away already how much? Nearly $35 million back. And here, if we look total liability, it was last quarter, it was 637 million, and now 579. So 58 million dollars reduction in their liabilities. So they can reduce it liabilities. So the next thing we have to know how much net profit they expect to get. Not even net profit, cash flow. Okay, prediction. We don't have these figures here on the cash flow, but you can expect, like if we go back in let's say value line, we can see that their cash flow was always higher than an income per share. You can see all the time higher. So now we expect if their net profit would say was here 250 million. So if cash flow will be a bit higher than 250 million, so there is no cash flow per company. So assuming that it's going to be about 280 million, if they keep $3 in profit per share, okay, so it means that they need only a couple years to give all their money back, okay, to pay their debt which they have right now from the profit. We are not taking into consideration what they have currently in cash, because they have some money in cash. They can use that cash to pay their liabilities. So they're quite fine. They have no problems with the debt payments. Okay. Now let's have a look how much money they can expect to make. All right. So before I switch to the next slide, I want to ask you, do you think, guys, that the fact that they reduced cash assets in their company will affect their future performance, or it won't affect their future performance? No, correct. Will it affect their future performance, profitability? No. They're going to get same amount money from their customers. They're going to get same amount of profit which they had before. The only thing here is the total political and economical shift within like reduction of sales level, which they had, and we saw that 18% decrease in operating profits. That's the thing which we have to pay attention. Is it temporary thing or is it a permanent thing? And then when we look at this industry and we think, okay, what those biggest companies are going to do? Are they going to switch from companies like Syntel to local suppliers? I don't think so. I mean, like if you're a business person, you're trying to reduce your costs. And if Syntel provides you this opportunity, you're going to keep working with the companies like Syntel, especially if the switching cost is very expensive. Because imagine that they have to switch from Syntel to any other company. It's quite expensive because they have to pay quite a lot of money for integration and with other systems, okay, and retrain the staff and etc., because business processes will change and some other things. So yeah, so for us, first of all, we looked that the amount of cash they paid out doesn't affect future profitability. Yes, absolutely, Dory. You might switch to another India Asian company to minimize long-term expenses, but when you analyze it, they will have about similar price level, right? That company wouldn't have any advantages. And when you look at Syntel and compare with other companies in the same sector, Syntel is pretty competitive in this area compared with other companies. And not only because of price, but also because of their qualified staff. They usually employ people with high qualification, with like a lot of knowledge, maybe less experience. They pay them much less, but they're all high qualified. Actually, you know what, guys? Only a few hours ago, maybe 8 hours ago, there was a very good article on Seeking Alpha regarding Syntel. Fantastic article. And it describes all these advantages and disadvantages which Syntel has. So I definitely recommend you to read that particular article. If you want, I can post it in our Facebook group, just that you find specifically that article. Just definitely recommend it. It explains a lot about their competitors and how they operate within them, and etc., etc., etc. So it's pretty good article. I probably post it after this masterclass that you can have a look at this. Okay. Now, okay, so let's have a look at another positive thing. So what we can see here, insider ownership, 29%, 29.9%. Now, guys, tell me, is it good or bad? That 29, like nearly 30% of the company owned by directors. Fantastic, right? So if we look at other companies, very often it's 1%, 3%, 5%. Here, 30%. 30% of the company owned by their management. That's a fantastic. Okay. Another thing, last 12 months, amount of shares bought, amount of shares sold. So net activity. Now, guys, what they're doing, management, that's the insider share traded. So that's the top management buying shares or selling shares. What they do, they are buying shares. So the question is, why the heck are they doing? Do they believe in company if they're doing it or not? Of course. You're not going to buy shares if you don't believe. And if you work within the company, you're insider, you definitely understand that this company has a potential. The interesting enough that majority of these shares were bought at a level price of $18, $20. So it's not at the current level of $16. So it's at higher levels. So they were happy to buy at that level. So I presume maybe they are buying right now, but we will find out about it only when they submit their reports, which they're doing every quarter. Okay, the directors have to show that they bought the shares. Okay, so that's a positive thing for us as investors.